Private equity. It's a massive, multi-trillion-dollar industry that has its hands in almost everything. But for most people, it's a total black box. Well, today, we're going to pull back that curtain and give you the blueprint.
Right? It's a question a lot of us have. We see the headlines about these huge billion-dollar deals, but what's really going on behind the scenes? What is the actual model that drives this incredibly powerful industry?
So let's cut through all the noise and the confusing jargon. We're going to break this whole thing down step by step. By the end of this, you'll have a really solid handle on how the world of private equity actually works.
All right, first things first. Let's just start with the name itself, because honestly, it tells you pretty much everything you need to know. It really does break down this simple. Private, because these firms invest in companies that aren't publicly traded on, say, the New York Stock Exchange. And equity, because they are buying ownership, a real stake in the company. Here's an easy way to think about it. Buying public stock is like buying a ticket to a concert. Sure, you're in the building, but you're not running the show. Private equity, that's like buying the entire concert venue. You own it, and now it's your job to make it a huge success.
So who exactly are the people buying these venues and where are they getting all this cash? To get it, you really just need to know the two main parts, the people running the show and the money they have to play with.
On one side, you've got the general partners, or GPs. These are the fund managers, the deal makers, the ones on the ground. And on the other side, you have the limited partners, or LPs. These are the investors with deep pockets. Think huge pension funds or university endowments. They provide the fuel. And that's a really important distinction, because the GPs have unlimited liability, meaning their own personal assets could be on the line. The LPs, though, their risk is capped. They can only lose what they put in.
And the way the money moves is pretty unique. LPs don't just write one giant check and hand it over. First, they make a commitment to the fund for a certain amount. Then, when the GPs find a company to buy, they make a capital call. That's basically them saying, hey, remember that money you promised? We need a piece of it now. And that called-in capital is what gets used for the investment. It's like an on-demand system for deploying billions of dollars.
Okay, so we have the players and we know how the money moves. But what's the actual process? What does one of these funds do day to day? And more importantly, how does everyone get their payday at the end?
You have to understand, a private equity fund is a marathon, not a sprint. We're talking a typical 10-year journey. It starts with fundraising, getting all those commitments. Then, for the first 5 years or so, they're in investment mode, buying up companies. After that, it's all about value creation, getting their hands dirty, improving operations, and making those companies more profitable. And then, finally, comes the exit, where they sell those companies and ideally make a lot of money.
So if you remember nothing else from this, remember this. The entire strategy can be boiled down to 3 simple words: buy, improve, sell. That's the whole game. They buy a company, they actively work to make it better, and then they sell it for more than they paid. Think about it. They might buy a small coffee chain, help it streamline its supply chain, build out an online store, and then sell it to a bigger competitor a few years down the line. That's the blueprint.
So how do the general partners get paid for all this hard work? Well, it all comes down to the legendary 2 and 20 model. It's a compensation structure that has made some private equity partners absurdly wealthy. The 2 in 2 and 20 stands for a 2% annual management fee. This is calculated based on how much money is in the fund. And this isn't profit. It's what keeps the lights on. It covers salaries, office space, you name it. And it gets paid out every year, win or lose. But this is the real prize. The 20 stands for 20% of the fund's profits. This is called carried interest. It is the ultimate performance incentive. If the GPs make their investors a ton of money, they get to keep a huge piece of the pie for themselves. It's the big reward for a successful exit. Now, there's usually a catch. The GPs don't just start taking 20% from the first dollar of profit. Most funds have what's called a hurdle rate. You can think of it like a high jump bar. The fund first has to deliver a minimum return to its investors, let's say 10%. Only after they've cleared that hurdle can the GPs start collecting their big bonus. Okay, for this last part, let's dive into the fine print, because the way these massive profits are accounted for, especially when it comes to taxes, is at the very center of a huge debate on Wall Street and in Washington. This is the billion-dollar question, right? When a general partner gets that massive check from their carried interest, how does the government tax it? Is it like a regular salary, or is it treated as something else entirely? And this is the core of the whole debate.
Right now, carried interest is typically taxed at the lower long-term capital gains rate, which is around 20%. But critics argue it's not a capital gain, it's a performance fee. It's compensation for work, and they say it should be taxed at the much higher ordinary income rate, which can be almost double.
Now, the people who support the current system say this favorable tax treatment is absolutely essential. Their argument is that it's what incentivizes these GPs to take the huge risks needed to turn companies around and generate those big returns for investors. Investors who, again, are often pension funds that millions of everyday people rely on. So that's the central question it all comes down to. Is this special tax treatment a fair reward for taking risks and growing the economy? Or is it a loophole that lets the very rich get even richer? It is a fascinating debate that is far from over, and it really gets to the very heart of what private equity is and what its role in our world should be.